Welcome to Investomania, brother. Boom! Welcome back, Investomaniacs. It's the one, the only, the most electrifying man in investing and entertainment today. The Knight Rider. Last year, Apple hit that mythical $1 trillion market cap point. Shortly thereafter, Amazon also briefly breached that $1 trillion market cap point. But that was like so 2018. New year, new me. With a decent-sized hit to the former trillion-dollar babies the past few months, and just the overall stock market, we now have a new trillion-dollar race on our hands. The contestants are the same they were last year. Apple, Amazon, Microsoft, and Google. But this time around, I'm not betting my money on Apple. In fact, Apple has taken the hardest hit of the four. A few months back, it had the largest market cap in the world, peaking around $1.1 trillion, but now it has fallen all the way down to last place, at least of these four, with a $720 billion market cap. That's a 35% decline, people, meaning you will now need over a 50% gain just to get back to even if you bought at the top. That's rough for a company like Apple, but Amazon, Microsoft, and Google also saw their own decent-sized declines, but not to the magnitude of Apple's. And that makes sense, as Apple has been experiencing more significant issues relative to their peers due to slowing iPhone sales and their heavy exposure to China. Back in November, Apple's management decided to stop breaking out iPhone sales numbers in the reports. This frightened some investors who fled the stock, taking that as a sign that iPhone sales were decreasing. This turned out to be correct, although it is primarily due to their heavy exposure to China and the trade war. Microsoft held up decently well in the decline relative to its peers, so much so it ended up being the most valuable company in the world for a while, as it continued delivering strong numbers. Then Amazon regained some of its losses as the overall stock market rebounded, and it leapfrogged ahead Microsoft to now be the most valuable company in the world. That brings us to our current standings. Amazon is in first place with a $802 billion market cap, followed closely by Microsoft with $789 billion, then Google gaps down to $737 billion, and Apple at $720 billion, as we already mentioned. So, now that the market appears to be set for a rebound, provided the Fed behaves, which it now appears they are going to, and they're going to take more of a wait-and-see approach instead of just charging full-on with rate hikes, and provided we don't have any particularly bad news come out about the Chinese trade war, we should start looking for that $1 trillion winner once again. While Apple was the majority favorite last time, with some believing Amazon would capture that title, this time, I believe Amazon will certainly be the victor. Now, of course, it's easiest to choose Amazon as it is currently in first place. But, guys, Microsoft is less than 2% away. For all intents and purposes, that's a neck-to-neck race. And let me be clear, if the market caps were reversed and Microsoft had a 2% lead, I would still prefer Amazon over Microsoft in this race to $1 trillion. So, what do I like about Amazon? First, they're still growing revenues at a stupidly fast pace for a company of this size, with its most recent quarter posting an impressive 29% year-over-year gain. That's a growth rate which will still attract many growth investors. However, in 2018, Amazon made the shift to start focusing more on profits. Amazon is perhaps the most infamous money-losing company in the world, at least before 2018. Virtually since its inception, Amazon's strategy has been to reinvest all profits and then some into growing the business. Now that they have damn near taken over, well, let's not say the world, but at least the United States, they now are at a point where they can start raking in massive profits. This gradual shift to increasing profits will over time bring in a new demographic investors. You know, those who care about like PE ratios and stuff. Additionally, all cylinders are firing at Amazon. Amazon Web Services, AWS, continues to post impressive growth and maintain its dominance in the cloud infrastructure space. Plus, Amazon has really kicked up its advertising. I have mixed feelings about this. It will certainly help propel the revenue, profits, and stock higher for the next several years and help them get to $1 trillion. But I am concerned about this potentially having a negative impact when looking many, many years out, like more than 5 years out. To understand why, let's take a quick look at history. Who was the OG superpower of internet advertising? Google! And what was the #1 worldwide spender on Google Ads in the early days? Amazon. That's right. Amazon, back when it was a little itty-bitty company, they were the #1 spender on Google Ads. While Amazon's and Google's businesses didn't overlap much in those early days, they are fiercely fighting for the same market space today. Google's business is ads, right? That's how they make their money. Google sells ads. They created the Chrome browser. Why? So they could control the default search engine on the browser and have control over the ads on search. But then they created Chromebooks. Why did they create Chromebooks? So they could control the default browser on the device and therefore create control the default search on that browser. On the mobile side, they created Android. Why? So they could control the default search app on mobile. Google realized to protect search, which is where they make their money, they needed to provide the default software and or hardware the users were using. Amazon has had a similar experience. Once they became the dominant force in online shopping, they shifted some focus onto protecting that dominance. And how do you protect that dominance? By providing the default software and or hardware the users are using. What are they holding in their hand? The actual devices and the kind of the default software on those devices, not just some weird add-on or site you go to. By Amazon selling these devices, and especially these past few years, they're really pushing their devices, and they're doing it at razor thin margins, and sometimes even below cost, because they realize the importance of getting these devices into the hands of the consumer. Why do you think they're pushing their tablets, smart speakers, and Fire Sticks so hard? Because they understand if you're using their device, they have control over all the default apps on that, the default search. If you search for something on with an Amazon smart speaker, is it going to tell you what's on Amazon or what's on some other random thing? If you're looking to buy something, obviously it's going to tell you what's on Amazon. It is very possible, without Google selling ads to Amazon in those early days, Amazon may not have become the amazing superpower it is today. But Google did sell ads to Amazon, and now those two companies are fighting tooth and nail for market share in the same. Obviously, they still have very different overall businesses, but they are fighting for those end devices, the smart speakers, the smart TVs, the tablets. Of course, Amazon tried to get into the smartphone market where Google also is. That didn't work out, but I think it's just a matter of time. I think we all agree sooner or later, Amazon will get back in to that smartphone market. So I am concerned about Amazon ramping up on their advertising and eventually potentially creating a future competitor for itself, as Google did with Amazon. However, that won't be an issue for many, many years. And in the short term, it will only push the stock higher. So that's not a concern you need to worry about now, but I just want you to keep it in the back of your head for years down the road if you do want to be a long-term holder of Amazon. You also have to take a look at the current state of the market. Just days ago, Target, Kohl's, Macy's, and L Brands, that's Victoria's Secret and Bath & Body Works, all reported a pretty sucky Q4, which includes that all-important holiday sales numbers. Now, you have to ask yourself as an investor, do you think the consumer isn't buying as much? Or do you think they're just not buying at brick and mortar locations anymore? I wager it's a little bit of both. I do believe the consumer is softening a bit, but I also believe there is an ongoing transition from brick and mortar to online. It's been happening for years, and I still believe it's occurring. I don't think it's done yet. I know personally, for my holiday shopping, with the exception of a couple things that I bought at Five Below for my girlfriend. By the way, that's another Investomania favorite, Five Below. Definitely recommend it. I did 100% of my shopping on Amazon. Mostly thanks to the free shipping with my Prime membership. Why would I go out to a store, deal with traffic and wasting a bunch of time buying something for 20, 30, 40 bucks and then go through the hassle of mailing it? And I don't even know how to do that stuff anymore. Going to like a USPS thing or something. I don't even know where those things are. Paying another $10, $20 for shipping? Why would I go through all that hassle when I can just buy it on Amazon for the same price or less and have it shipped anywhere in the nation for free? With no minimums, no $20, $30, $40 purchase minimums like a lot of other sites have. Of course, that comes with the Prime membership, right? I don't think that's necessarily the case if you don't have Prime. So the weakness in the brick and mortar stores, I think, is a strength for Amazon. We're not going to know for sure until they report the next quarter, but I anticipate a good quarter. Now let's talk about Microsoft, another strong contender to hit $1 trillion in the not-so-distant future. Satya Nadella has done a fantastic job taking the formerly slow-growing Microsoft and transforming it back into a massive growth company. Azure, that's Microsoft's cloud business, is doing fantastic and now is in a solid second place to Amazon Web Services. Microsoft 365 has continued to put their core products back into a growth trajectory, and LinkedIn, the $26 billion acquisition, has shown strong numbers in recent years and appears to be a good acquisition. Microsoft is on strong footing, which is why it saw the smallest drop relative to its peers in the recent market sell-off. If some bad news comes out about Amazon, Microsoft will be right there to lead the charge towards $1 trillion. Now let's talk about Google. Remember, Google, technically Alphabet. I still call it Google. I'm sorry. I just want to call it Google. It's Google, not Alphabet, but whatever. Alphabet, Google. It's primarily an advertising company, as we kind of talked about earlier. Google has been losing search market share for years to Microsoft's Bing, and has been losing revenue market share to Facebook ads for years. However, both of these markets keep growing so damn fast that even though Google's losing market share, Google itself is still growing in terms of revenue. Plus, you now have Amazon entering that advertising space competition. This makes Google a bit of a complicated story to tell. Is this the story of a company which will continue to increase revenues for many years to come? Or is this a story of a company which will eventually see, perhaps not declines, but at least say its growth is going to significantly decline due to the increased competition in Facebook and perhaps Amazon, and then a little bit smaller competitors like Twitter and Snapchat, etc., LinkedIn, right? On the plus side, Google has YouTube, and YouTube remains a dominant force for advertising on video. Plus, with the addition of their growing premium option for $11.99 a month, at least that's currently what it is, they have a way to earn money independent of advertising, and I do like that. Then there's all the bonus stuff you get with Google, like autonomous driving with Waymo, Verily Life Sciences, which if one of these companies like this works out, it could move the needle for Google in a noticeable way. With Google's most recent quarter clocking in an impressive 21% revenue growth, it is still a high growth and extremely high quality company. I definitely recommend it, just perhaps not quite as much as Amazon or Microsoft, but all great companies. Last but not least, well, perhaps in this case least, we have Apple. Listen, I have liked Apple for years, and I still like Apple. If you're looking for a long-term investment, Don't care about this silly race to a trillion and want something a bit more conservative, relatively speaking? I think Apple is a good investment right now. The stock has been beat up, more so than Google, Amazon, and Microsoft. And I think it's a good time to get in. After its recent sell-off, Apple is only trading for about 11 times next year's earnings, far cheaper than Amazon, Microsoft, and Google. It also has the highest and safest dividend of the 4 stocks. Heck, Amazon and Google don't even have a dividend to speak of. However, if you are looking for more short-term growth, I wouldn't recommend Apple right now or probably in the future. It's too dang big. It's too established in a market that's not growing fast enough if you're looking for the high growth and the short-term growth. While it is the cheapest of the 4 stocks, it will also likely have the hardest time growing revenues. Amazon's core business and AWS are both still on fire. Microsoft 365 and Azure are growing like a weed. Google, well, they just happen to be in a market which isn't as developed as the smartphone market, and as a result, we are still seeing stronger growth. There is still a lot more advertising that is going to be transferred over to internet-based advertising, and a lot of that's going to go to Google. There's a lot more of that's going to happen than brand new people who need smartphones. Apple, relatively speaking, is in a more saturated market with slower growth. In Apple's defense, they are growing revenues rapidly in their service stream, and that's the Apple App Store, okay? That is doing fantastic. The problem is the company's just so dang big. The smartphones account for about 60% of revenues, and that is not growing particularly quickly. It's hard for even these massive successes in the revenue streams, in the service streams, rather, to push the needle for Apple as a company overall. With iPhone sales currently slipping and the trade war with China not appearing to be going away anytime soon, Apple is certainly the underdog in the race to a trillion this time around. To bring it on home, all 4 of these companies are amazing and have come down a lot, creating a solid buying opportunity. And you would not be wrong to buy any of them. However, here's how I would break it down. Amazon has the best chance of reaching $1 trillion first, and also has the best chance for short-term stock growth, but it is also the riskiest. Microsoft currently has the second best growth prospects, but it is safer than Amazon and sports a solid dividend. Apple is in the short term, it has increased risk relative to the other 3, but long term is the least risky of the 4 stocks. It's by far the cheapest and also sports the highest and safest dividend. Google is a bit in the middle in terms of growth and risk and lacks dividend. I wouldn't say it's the best or worst in anything. So there you have it. Which stock is your favorite, and which stock do you think will reach that mythical $1 trillion market cap first?
That's the bottom line, because Stone Cold said so.